Welcome to the Deep Dive. We take one source, go deep, and pull out the key insights so you get the shortcut to being genuinely informed.
That's the plan.
Today, we're jumping back to 2001, our source, the annual report from Giverny Capital. It's a fascinating look at a unique money manager.
It really is. And the goal today is to extract those nuggets, those long-term investing principles that, frankly, still hold up.
Absolutely. And you have to remember the context of 2001, right?
Oh, definitely. I mean, you had the dot-com bust still echoing, a recession kicking in.
And then the shock of September 11th, just a massively turbulent time.
Exactly. So seeing how this one firm navigated that year, well, it's pretty instructive.
And this report isn't just numbers. It was originally in French, got translated. It's full of philosophy, lessons learned. It's quite rich.
It is, far from your standard dry annual report.
So what's the core thing about Giverny? What makes their approach, unique?
Well, right off the bat, it's their foundational philosophy. They're laser-focused on growth and intrinsic value.
Okay, so the real underlying worth of the business, not just the stock price ticker.
Precisely. They're not chasing market sentiment. It's a fundamentally different game than most conventional portfolio management.
Very much being different. It reminds me of that John Templeton quote.
Yeah, it is impossible to obtain a performance superior to the average unless you do something different from the average. That seems to be their mantra.
So did it work? Did being different pay off in a year like 2001?
Well, look at the numbers. Giverny returned 15% in 2001.
15%, when their benchmark did zero.
Zero. And the S&P 500 was actually down 6%.
Wow, okay.
Now, you got to mention, there was about a 5% tailwind from the Canadian dollar variation.
Right, context is key. But still, even taking that into account.
Even factoring that in, it's a huge outperformance. Really validates that focus on value, especially when the market's going haywire. A key lesson right there.
And zooming out, the long-term picture is even more impressive, isn't it?
It really is. Since they started, September 93, their annual return was 23.5%.
23.5%.
Annually. Compare that to their benchmark at 13.6%, or the S&P at 15.9%.
Huge difference.
And in total Canadian dollar terms, over that period, Giverny hit 481% growth, the benchmark, 190%, S&P. 242%.
That's staggering. But you mentioned the currency effect earlier.
Yeah, you have to be fair. The fallen Canadian dollar since '93 did add about 3% a year to their return. Still great, but important context.
And they adjusted their goals too, right? They started out pretty ambitious.
Very ambitious back in '93, talking about a 20% annual return and handward 10% better than the indexes.
Which is a lot.
Yeah. So by 2001, they looked at the landscape, maybe listened to Buffett talking about potentially lower returns, like 5–8% for stocks.
Okay.
And they revised their own goal. They aimed for 10–12% annually, or 5% better than the indexes. Still ambitious, but more grounded in the current reality.
That dynamic goal setting seems really smart. Not just sticking to some old target.
Right, and they really emphasized alignment with their investors. There's that great quote.
Oh, the one about being in the same boat.
Exactly. I have my own money in the same stocks as you, so we're in the same boat.
It's powerful. It directly counters that image of the advisor in a yacht while the client's still in a rowboat.
It builds trust. And you need that trust, especially when you hit rough patches like the 2001 recession.
Which was the first recession the fund had actually experienced since it started.
Yeah, and the manager's view. Recessions are an inevitable part of the system, maybe even healthy.
Healthy. How so?
Because it's during those tough times that the strong businesses, the winning companies, can actually gain market share from weaker rivals.
Ah, okay. So they see downturns not just as something to survive, but as an opportunity.
Exactly. An opportunity to distinguish the great from the merely good.
That really ties into their lesson from the aftermath of 9/11, doesn't it?
It does. That phrase they used. It is better to buy in rainy days than in sunny days.
Explain that a bit.
Well, sunny days often mean over-optimism, inflated prices, everyone's feeling good, maybe be too good.
Right. Prices get ahead of reality.
But crises, rainy days, that often brings panicked selling. People dump stocks at any price.
Creating opportunities for those with cash and conviction.
Precisely. Finding long-term value when everyone else is running for the exits, developing that ability to tell sunny from rainy, that's a key skill they highlight.
Such a timeless piece of wisdom. Now, shifting gears to tech in 2001. What a mess.
Oh, absolutely. The hangover from the 99-2000 bubble was brutal. Excesses vanished, companies vanished.
And specific sectors got hammered, right?
Semiconductors, telecom equipment, Revenue's down 50%. Telecom was worse because of all the leverage, the debt they'd taken on. Survival was the name of the game for many.
Makes you wonder if tech can have durable advantages, those moats.
It's the perennial question in tech. Giverny's take was interesting. They didn't think the tech revolution was over.
Just pause.
Yeah, they called it a deep and long pause. Required patience. Lots of it.
And they had history with tech, hadn't they?
Yeah.
Buying things cheap earlier on.
They had. They mentioned buying Intel at 9 times earnings, Sun Micro at 5 times back in '94. So they weren't anti-tech.
But they saw a core problem.
Right. Not necessarily valuation itself, though that was insane in the bubble. The bigger issue was the changing nature of the businesses. Product cycles were incredibly short.
Like the Cisco example.
Exactly. Cisco taking a $2 billion inventory charge in 1 quarter because stuff became obsolete so fast, that tells you something.
It really underscores how hard picking long-term winners is in that space. They used an old example, didn't they?
Yeah, a 1983 Reader's Digest piece on personal computers. Commodore, Apple, Tandy, Osborne.
Names from the past.
Many failed. Even Apple, which obviously became huge later, had like 15 years of no stock appreciation, stopped its dividend for a while.
So the takeaway isn't avoid tech, but
be incredibly careful about predicting specific long-term winners in rapidly changing fields. It's tough.
yet they also point out that some tech companies do build lasting businesses.
Absolutely. They mention HP, Motorola, that 20,000% return over 44 years is just wild. Texas Instruments, companies that went public way back and rewarded investors massively.
So it is possible to build a moat in tech.
It is. They pointed to Microsoft, Applied Materials, Intel, Cognex as having durable models even then. The key is focusing on that fundamental durability, not just the latest hype.
So when Giverny looked at a tech company, what were they actually looking for? What were their criteria?
They laid out 5 factors, and crucially, they said, forget valuation, the 5th factor, if you don't have clarity on the first 4.
Okay, what are the first 4?
1, business model, market share, innovation capacity. 2, financial structure, strong balance sheet, good margins.
Makes sense.
3, quality of management. 4, long-term growth prospects. Only then do you look at number 5, market valuation versus your estimate of intrinsic value.
That qualitative deep dive comes
It
first.
has to. Otherwise, the valuation number is meaningless.
And true to their rainy days philosophy, they didn't just watch the NASDAQ crash, they acted.
Right. They bought back into Cisco, bought JDS Uniphase after the crash. About 20% of their new investments went into that beaten-down tech space.
Sticking to their principles, let's look at some specific companies in their portfolio back then. M&T Bank was their biggest holding. Why?
Well, M&T just kept performing. In 2001, EPS was up 13%. Really solid.
And the efficiency, the returns?
Return on assets, ROA, was 1.7%. Return on equity, ROE, an impressive 28%. They loved the CEO, Robert Wilmers, and pointed out this amazing under-the-radar track record, 18% compound annual growth in EPS since 1982.
18% CAGR since 82.
Wow.
Right.
The lesson there is finding those quiet compounders that the market might be overlooking.
Then there was Cognex. They'd owned it since 96. Sales dropped 50% in 2001, yet they held on. What was the thinking?
They believed in its moat, its competitive advantage in machine vision. They saw near monopoly potential emerging from the downturn.
And the balance sheet helped.
Massively, no debt. Around $300 million in cash. That's $6.60 a share in cash when the stock was at $25.60. That financial strength lets you weather storms and come out stronger.
Another interesting one was Bed Bath & Beyond, BVBY. A retailer doing well in a recession. EPS up 27%. There was that rule the founders had.
Yeah, Warren Eisenberg and Leonard Feinstein. Their rule was simple. Expand using profits, no debt.
No debt for expansion. That's unusual for retail.
Very. It meant slower growth initially, only 22 stores by 1985. But it was solid growth. They opened their first superstore in '87.
And after going public.
Went public in '92. Over the next 9 years, stores up 10 times, EPS up 12 times, market value up 20 times. They were actually growing faster than a Walmart and Kohl's.
All without debt for expansion. Incredible discipline.
It builds resilience. And Giverny, again, used dips, like after 9/11, to increase their investment, buying on rainy days.
Not everything works out right away, though. They had Yahoo, too.
Yeah, a small position bought in late 2000. By 2001, sales were down 30%, profits gone. Ouch.
So why hold it?
They believed in the important franchise value. They saw great long-term potential, but explicitly acknowledged it would require a lot of patience. Sometimes you invest in the potential even when the present looks grim.
And Progressive Core, the insurer.
Bought in 99, they were challenging Jayaco, became #1 in online car insurance sales. Profits were good in 2001. Stock had more than doubled since they bought it.
So spotting an innovator disrupting an established industry.
Exactly. Seeing where growth could come from, like the internet channel back then.
Their biggest Canadian holding, Le Groupe BMTC, offered a different kind of insight, didn't it?
It did. They noted that Canadian markets sometimes offer bigger gaps between market price and intrinsic value. Good hunting ground for value investors, even if sustained high growth is maybe rarer.
And BMTC was a winner for them.
Big time. Bought in 95 at $3.50 a share. By 2001, it was $17.50, a five-bagger. That's a 26% annual return.
On a company some called Deadwood.
Yeah. They credited CEO Yves de Grosset. And get this. At its low point in 2001, it traded at 4 times earnings, including its cash. Just shows the rewards patience can bring in overlooked places.
Okay, let's talk about selling decisions and the really interesting part, their mistakes. What did they sell in 2001? Hewlett-Packard.
Sold HP. They saw an existential crisis, especially with the controversial Compaq acquisition. They quoted Buffett, "When you're in a hole, the worst thing to do is continue to dig."
So recognizing when the fundamental story breaks.
And having the discipline to get out, even if it's a famous name.
They also sold Liquidation World. That had been a good investment, right? A 5x return.
It had been great, but growth had slowed dramatically.
Yeah.
From 33% EPS growth annually, 93-98, down to just 4%, 98-01.
So growth stalling was the trigger.
That and concerns about management depth. They cited Philip Fisher on this. Could the team that ran 50 stores effectively scale up to 250? They weren't sure. So even after success, if the thesis changes, you sell.
On the buying side, post-crash tech bets. Vitesse Semiconductor.
Yeah, they'd watched it since 98. Bought it after it cratered from $100 down to $15.
What was the attraction?
Leader in high-speed chips, developing cool new tech indium phosphide for super fast data transfer. But they were clear-eyed about the risk. Competitors like Applied Microcircuits had alternative tech. High risk, potentially high reward.
And the other, buy Level 3 Communications. Sounds really out of character for them. Unprofitable, tons of debt.
Totally atypical. $14 billion optical network built on debt. Why buy? Huge admiration for board member Walter Scott Jr., also on Berkshire's board, and CEO James Crow.
So a bet on management.
A big bet on management and strategy. The stock had fallen from $130 to $12, then even hit $2 before ending the year around $5.
And they bought more.
They did, after the company managed to buy back some of its debt really cheap, like 30 cents on the dollar. But they were careful, limited the position to just 3% of the portfolio because of the risk. Sometimes you make exceptions, but you manage the risk tightly.
It takes guts to admit mistakes publicly. Giverny's mistake du jour tradition, inspired by Buffett, is great. Let's hear the 2001 medal winners. Bronze, Mattel.
Ah, Mattel, they knew the company well. The mistake. CEO Jill Barad made that enormous mistake buying the Learning Co. Stock tanks to $10. Giverny didn't buy back in.
Even though they knew the business.
Right. Then new CEO Robert Eckert comes in, basically gives away the Learning Co., refocuses on brands, cuts debt, stock zooms 70% to $17. Giverny missed it.
Any excuse.
The manager wrote, "I'd like so much to give you some excuse for this mistake, but I can't find one." Brutal honesty, the cost of inaction.
Okay, silver medal. Health Management Associates, HMA. What went wrong there?
Sold at early 2000. Why? A single so-so quarter plus uncertainty about Medicare rules, something the manager felt was a disadvantage being Canadian.
So short-term worries.
Exactly. But the company turned out to be resilient. Earnings bounced back, stock went up 50% in a bear market.
And the mistake was?
Buying it back later at a 25% higher price. Clear lack of patience. Letting short-term noise dominate.
And the gold medal. The major mistake. First Data Corporation, FDC. This one sounds painful.
Oh, yeah. Sold in 99 at $45. They'd bought around $35, so a small profit, but they knew it was an ideal business model.
TAR Transactions, Western Union.
Near monopoly with Western Union cash transfer, big potential online. They'd studied it deeply in 97, but some hiccups in 98-99, selling off some bad acquisitions, growth seemed to stall, so they sold.
Okay, understandable maybe.
But then, late 2000, fundamentals looked great again. They even wrote an article saying how good it looked. Did they buy it back? Nope.
And the stock?
Nearly doubled in the next 18 months. Just a massive opportunity miss due to, what? Lack of conviction, impatience, even after doing the work.
Oof, so the common thread through all these medals.
Patience, patience, patience. They hammer it home. Quote Louis Rouquezer interviewing Philip Carrot, 75 years of experience, the most important lesson. patience.
And the report says lack of patience is still a main cause of economic losses.
It underlines that investing isn't just spreadsheets, it's psychology, it's emotion. Patience is the shield against those self-inflicted wounds.
This ties into their broader philosophy section, right? The idea of business and investing as an art.
Exactly. They quote Pierre Pellido. Business is an art, meaning it needs creativity, open-mindedness, and patience again.
And being an artist often means being a contrarian.
Right. Rebelling against the conventional. They quote artist Marc Seguin. It's an affirmation, period. Leading to this idea of an artistic stock-picking method, affirming companies that are ahead of the curve.
It's about independent vision.
Yeah.
And they look for that in the companies, too, citing Philip Fisher.
Yeah, Fisher wanting companies working on things others aren't even aware of yet. Companies that welcome dissent, not stifle it. Where people can criticize management without fear.
And that culture of openness is key.
It fosters adaptation, innovation. It's what they look for. And it links to why portfolio management is often solitary. Buffett's mirror quote.
My vision of a group decision is to look into a mirror.
Yeah. It takes individual conviction, which requires this tricky balance.
Self-confidence and humility. Seemingly opposites.
But both essential. You need self-confidence to judge companies, to have that huge patience to buy what Wall Street hates.
But stand apart.
But you absolutely need humility when you're analyzing knowing what you don't know, when you inevitably make mistakes.
And especially after you've done well.
Ironically, yes. Humility is most needed after 1 or 2 great years of performance, because the market loves to punish arrogance swiftly.
So confidence provides the courage, humility provides the grounding.
Beautifully put. And they connect humility to reason, citing Eric From
The Art of Loving.
Saying objectivity reason is only possible with humility, when you escape those dreams of omniscience and omnipotence.
Seeing reality as it is, not how you wish it were or fear it might be.
Regardless of your own biases and needs, that's profound for an investment report.
And the final analogy, jazz and investing.
Yeah, quoting Woody Allen on jazz musicians learning through osmosis, just soaking it up out of love for the music. The idea is investing well involves that same kind of deep immersion, driven by passion and curiosity. It's not just mechanical.
So wrapping this up, the dive into Giverny's 2001 report shows, well, a masterclass in navigating turbulence.
Absolutely. Long-term view, deep analysis, patience, learning from mistakes, and that crucial blend, confidence tempered by humility.
Timeless principles, really.
Yeah.
They work because they acknowledge both the market's nature and our own human nature.
Which leads to a final thought for you, the listener. If this art of investing has parallels with From's art of loving, rooted in humility and seeing reality clearly.
Okay.
What self-delusions, what narcissistic distortions might be clouding your investment view? And could embracing genuine humility actually unlock a deeper level of insight and, ultimately, success?